Okay, good afternoon. Hello, everybody. Today's the 21st of January, 2022. This is your weekly take on the market. I am your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Take a moment, read the disclaimer. I am not licensed, can't offer buy or sell recommendations. It's all for entertainment purposes, maybe, really for educational purposes. Okay, so we'll start with the markets. You know the drill. We'll go into the industry groups a little bit. I just don't see that much to do there. It's all the same. Look at a couple of stocks and then do the quote. All right. So let's start with the markets. And you should see a chart of the NASDAQ. Ugly day today. Got hit really hard. The volume was up. This is probably pretty close to accurate. It is about 1:30 my time, Pacific time. So the market's been closed almost 30 minutes. And the Netflix news didn't help. And so a lot of the big cap growth stocks got hit pretty hard today. So it's pretty ugly tape. The good news is it's becoming more and more obvious that we're in a bear market to everyone, right? I don't know exactly what the percentage is. I think it's all semantics. It's just a silly thing that somebody made up. You know, why did they pick 20%? Why isn't a bear market minus 18.8, right? Or minus 22.7? They just picked a nice, easy round number, right? So it's worthless in that regard. We're in a bear market. We have been for a while, especially in the growth area. And a lot of you, I think most of you out there are aware of that. So we're down 14% on the NASDAQ. It's pretty ugly, and we've been, screaming from the rooftops. The boy that cried wolf in NASDAQ. Relative strength makes a new high there. Price-wise, you get a new high in the NASDAQ, and the relative strength doesn't participate. Price-wise, you get another new high in the NASDAQ, no participation. Another new high, same. So you're never making higher highs in the relative strength. Like I've been saying for months, the NASDAQ was being dragged higher by the overall market, the strength in the S&P. Under the surface, there's just a lot of deterioration, Pelotons, Zooms, Teladoc. I can go on and on. There's so much damage. It's incredible. And then you made another new high in the NASDAQ there, and you actually peeked your head, at least, for half a brief moment. You had a chance that at least you were making, higher highs there, but then that deteriorated really fast. And then you can see here when the S&P made a new high right there. Let's go to the S&P. So the S&P makes a new high in late December, and the NASDAQ does not. And that's called a non-confirmation. So you have one index making a new high without the other. And that was the final straw for the market. It just couldn't take the pain anymore, and then just deteriorated really fast. You'll get that a lot. A lot of markets will bottom and top on non-confirmations. You're probably something you can go study and see. Tops are a process. They take a long time. And it's really, really difficult to recognize them. So I've been, very underinvested, did not like the setups in the market, didn't feel like I could be heavily invested with any kind of comfort for a long time in this whole area. While the NASDAQ was going up, it was kind of going up without me. So, but you have to kind of live with it. If the NASDAQ goes up 10% here and you go up 3%, but you're 30% invested, you have to know that that's probably going to happen. And that doesn't bother me. I don't mind. You can't try to beat the market every single month or even every single year. I think a lot of people will ask, what kind of, what's my performance going to be using CanSlim? Well, that's an impossible question because it's such a personal process. How much risk do you want to take, right? Are you going to use margin? So if I don't do as well as the market, doesn't bother me sometimes, because there will be years where, I can really beat I think last year I underperformed the market by a few percentage points. I'd have to look exactly, but didn't matter to me because I was not nearly invested. And one thing about the market, it's always fully invested. So when it's going up, it's fully invested, and when it's going down, it's fully invested. So this is one of the real gems of Can Slim. The outperformance throughout long periods is being under invested to zero invested in downdrafts. So I think in 2008, if I recall the numbers, Scott O'Neill said the portfolio manager, he said this publicly. This is not something, excuse me, that some kind of inside information, but he said publicly that I think the portfolio manager is down 3% in 2008. And the S&P was down, what, 40% or something like that. So that's huge outperformance. And so a lot of the outperformance is in that regard, So if the NASDAQ goes up 30 last year and you went up 25, but you've got your finger on the trigger to get out, like I do, because I felt like the market was long in the tooth. It's been a bull market for a long time. And so I just have to understand that and be okay with that. So the good news is, and I apologize if I've already said this, but this is the third time I've worked on this video. I had technical difficulties the first two times. So if I've said this already, I'm sorry. But the good news is it's becoming obvious that we're in a bear market. And when it's obvious, then everyone knows. And that means we're later into it for sure versus early into it. But there's a lot of damage. So it's going to take a long time to overcome this. Imagine you're a long distance runner. I'm going to steal one of Scott O'Neill's analogies again. And you twist your ankle. How long are you going to be out for? You might have to be out for 3, 4, 5 days, maybe a week and a half before you start running again. If you tear your Achilles, you're going to be out 6 months before you're running again. And so that's the market. The market, has it twisted its ankle or has it torn its Achilles? I would say the Achilles is busted. Maybe both of them are busted, and they tore their ACL as well. So it's going to need major reconstructive surgery, and that takes time. So you just have to be patient. S&P, just broke the 200-day today, whereas the NASDAQ, let's go back and look at that, has been below it for a number of days. You are very oversold for whatever that's worth. It's like a terrible, worthless indicator. Even Bill hated overbought, oversold. That's why we don't have them on the charts, because there's no value add. In fact, they probably will hurt you, because I imagine the market was super overbought coming out of the COVID crisis when it first rallied. And I bet it's, super oversold here. And it was probably really oversold before the 87 crash. I think the Friday before the 87 crash was a terrible, terrible day. And the Thursday before that was really bad too. So they're not really good indicators. And so, but we are undercutting a lot of lows. So I would expect some type of snapback, and then you can see how it holds up. If today wasn't a Friday, I was on IBD Live this morning. If it wasn't a Friday, I probably would have done maybe some buying, just thinking that maybe the market could have some type of snapback rally. But what kept me out and just quiet most of the day was it's a Friday, and I just didn't give me a lot of room to most bad Fridays are followed by bad Mondays historically. Not always, but that's a bad Friday can normally be followed by a bad Monday. And so today was Tuesday or something. Maybe the market could have caught a bid. So maybe, you have something like this, but this is starting to become a roof. And, you start living below this line, and that, you're just in bear markets. Go and study all the bear markets. They spend a lot of time like in here. So if we were to go to like 2008, oops. So you see how it breaks, tries to rally, breaks, tries to rally, boom, blows up. So like it starts living below these lines. If I fast forward, let's go forward a few months. I don't even know what it's going to look like. I'm just going based on remembering. You see how it just breaks really bad. And I bet, let's see if I'm right, but it's going to try to rally up here and then roll over again. Let's go. Let's fast forward a few months. Voila. Right. And I swear I didn't practice this before. Just that's how markets work. It tried to rally and it just, this became the ceiling, right? You see how you've got this 200 days, your ceiling, and it's not, doesn't mean it has to perfectly stop at it, a couple of days through there, but then whammo, right through. So back to current market, keep that in mind. If we start to get over here and this is like that and rolling over and this is rolling over, it's just not a time to be invested. You want to be patient. And that brings me to Ted Williams, which was Bill O'Neill was a baseball player as a kid, and Ted Williams was his favorite baseball player. Most of you probably know who Ted Williams is, but he's in the Hall of Fame. He's the last player to hit 400. I think he hit 406 one year. And he had this little chart where he knew how well he hit. You know, if the upper corner here, he hit 310, down there, it was 290. And in this, you know, he knew where his sweet spots were. And he knew where he was no good. So where does he want to hit? Where does he want to swing if he gets a ball anywhere in here? And so that's the same kind of thing you want to do with the market. You want to know what your sweet spot is. And right now it's not a sweet spot. NASDAQ could go up 3% tomorrow, and I'm not going to participate because it's not in my sweet, or it could go up 3% Monday. I'm sorry. I'm not going to participate. It's not in my sweet spot. So know where your sweet spots are and be patient. Wait for them. That'll bring me to my quote of the week. Industry groups, excuse me. Let's do them, and then we'll do the stocks. And I haven't really looked at them the last few days, but I'm going to guess they're exactly the same as before. All right, so industry group rank. Oil and gas, Canadian is 1, energy coal is 2, media periodicals, oil and gas, oil and gas, oil and gas. One thing I noticed yesterday on Thursday, I was in some oil and gas stocks, is near the end of the day, they started to lose a bid. And it became obvious to me that they were going to go down. And so I just got completely out of all of them. And it's because if you're a mutual fund and you're fearful of redemptions, you're not performing well, and you've got these stocks that are really having a hard time with a bid, you know, Net, MDB, Roblox, they have no bid. They just cannot hold a price for very long. You'd have a really, really hard time getting out of them. But so what do? You start looking around and you say, oh, well, we're up 47% in Apache, and that's got a bid. Let's get out of Apache. We need some liquidity. If you're a hedge fund and you don't have to be fully invested, you can be cash, you can be 30%, and you start, you know, your performance, you're down 3, 4, 8, 12%, and the year's just started, start to feel the pressure, you start doing some selling. So institutions have, you know, they have to sell where they can. Not like you or I can hit the bid on pretty, you know, on everything that I own. I can just hit the bid, and, you know, there might be a few penny slippage, and I'm not going to move the price. But if you have 7 million shares of NVIDIA and 8 million shares of Lam Research and 4 million shares of XYZ semiconductor, you start to feel the pressure from having all of those, and you start looking around for bids to raise cash. So they'll be, if it gets bad enough, they're just going to take everything down because it'll be a rush for liquidity. Bitcoin, for example, down, well, I'm looking at the futures, so don't at me if I get it wrong in the Bitcoin world, but the futures were down 12% today on Bitcoin. That's a big, that's a big hit. Why? 37.5 is the big number. Liquidity. You know, if you've made a fortune in AMC and GameStop and Tesla calls, and you got a bunch of Bitcoin, and you're just getting hurt everywhere. You start to look for liquidity, and those things go pretty fast. So the group's not really telling me anything at this point. All right. Stocks to watch. Let's look at Amazon. I think I mentioned Amazon. Let's go to the weekly. So you've got what's that? September, a year and a half of overhead supply now. Anybody who bought in this last year and a half is now underwater. And look at the relative strength, just ugly. I can't even explain some of the moves in some of these newer names like Task. This was a stock I was in and just like lamenting the sell, like, oh my gosh, I think I was out in the 50s and watched it go to 80. And here it is at 20, a DLO, another stock that is, you know, looks like a new leader. It looks like everything is so good. ASAN, just all the way back pretty much. What were some of the others? I just was flabbergasted at the moves that some of these stocks have made. So it's really bad out there. And Nvidia. Now these are the generals, right? So they're finally getting Nvidia. It's down 32%. Look at all that pink. 1, 2, 3, 4, 5, 6 in the last 8 or 9 weeks. 8 of 9 weeks down. That looks like it's under distribution. And then last but not least, everybody's favorite, Tesla. And actually, Tesla's holding up really well. I think I said that in a few previous weeks. It's holding in there like a champ. I guess if Tesla, I think if it breaks, if it has a bad bar like Amazon did, then maybe that will be, you know, a sign that they finally capitulated and got out of everything. But it's holding up pretty good, but I wouldn't be in it. I would not. Well, I'm definitely not in it. But I think the prices, that looks like it's going lower. Any other? I guess if you force me to be invested, it would be in like industrials, commodities, metals, you know, chemicals, stuff like that. I've owned Rio before. I actually bought Rio this morning because I was 100% cash. So I just don't like to be all cash. I feel like I don't have a good feel. So I have put on maybe a 7% position in Rio, and I just got out of it at the end of the day. I think I lost maybe 20 cents or something. And it wasn't that I was down 20 cents. The market was just closed too poorly. I just didn't want to deal with it. If the market had closed much better, then 20 cents is not a stop. I wouldn't have sold it just for 20 cents. But I told myself when I bought it right in the open. The market can't hold a bid, then I'm out. I'm getting out. So it's setting up another one that David Sato Chung mentioned on IBD Live. This looks really good. PDCE, excuse me, relative strength. I think it had the RS line blue dot today. Yeah, that looks pretty good. It's in U.S. exploration versus Canadian. That looks good. I like the setup in CLR, although it's a lousy week. That's good. You've got now a handle. I'm pretty certain this is going to switch to a handle. So it's not totally impossible for their stuff to be bought. It just depends on, you know, if you don't mind being in those types of groups. All right, let's go to the quote of the week. There we go. I just finished this book by Robert Leppo, The Speculator's Mosaic. Very small, short, thin book, easy read. Read it in one sitting almost. I think maybe 2 days, 2 sittings. I liked it. I thought it was pretty good. You know, it's not really any lessons about buy here, sell there, or anything like that. But it was about his journey as a speculator and some of the things that he'd done, and I like that type of stuff. So, but this is a great quote. He started out as a poker player, and I think poker is a lot of the same similarities to stock trading / investing. There's a lot of imperfect information. There's math involved, right? I know that aces will beat, kings 4 out of 5 times or 80% or whatever, but doesn't mean I'm going to win every time. But the odds of making a straight if you have 5-6 and the flop is 3-4-10, things like that, right? So there is some math involved, and there's some psychology and human emotion, managing your own emotions. So I think it has a lot of similarities. Okay, anyways, but he said the most important reason I was able to beat the game was that I learned 3 things. 1, to be patient. And in orange, that's what I've added. He obviously didn't have that in his book. So you need to be patient. And the main thing is the market direction. It's just so hard to swim upstream. So if the market's bad, you don't know if it's going to be bad for 6 days, 6 weeks, or 6 years. Now, probability wise, a lot like poker, I know that it's unlikely to change in 6 days based on what I'm observing. It doesn't mean it can't, but I'm just thinking in probabilities. It's unlikely to be 6 years. That's a long, long time. Based on history, you've only had a couple of really long drawn out bear markets like that. And nowadays, everything seems to move so much faster. So like a 1970s style bear market seems unlikely because of the way the dissemination of information is too fast. But it doesn't mean it can't happen. But those are low probability events, probably somewhere in between. So I need to be patient and just wait for the market. I know some people, there's an email that I got or we got about, this gentleman wanted to cancel his MarketSmith because of the market. And that's not uncommon, unfortunately. People do that. I think it's a mistake, but I get it. I was there. I understand the fear of that the market. And he emailed us and gave us all the reasons why he was planning to be out of the market for X amount of time. The Fed, the cycle of interest rates. After the Fed raises rates 3 times, then I can come back. And it's just impossible to game that, to know what the market's going to do. There's no way what the Fed's going to raise rates 3 times. Even if they tell us they're going to raise rates 3 times, they can pivot, the famous Powell pivot in December of 2019. So, and then 2, I don't know what the market's going to do. Even if the Fed told me what they were going to do, it doesn't mean the market will react exactly as I think it should. So you just don't know. There's a bottom line. So you just wait and observe every day and just be patient. And right now, as we sit here, market's bad. It's simple. It's black and white. It's very bad. So you're patient. You're waiting for your setup, right? You're like Ted Williams. 2, I know what hands to play. So there's, like a grid of, starting hands. 2 aces is best, 2 7 offsuit is worst, and everything in between. And there's hands you want to play. Now you can't always play aces because you'll never play. And when you do, you'll never get any action. So you want to move down the food chain a little bit to, and there's this kind of a sweet spot. And that's the same thing with stock selection. You can't always wait for a perfect stock. I can't always have earnings up 70% and ROE 42% coming out of a first stage cup with handle, and the industry group is ranked 3. You're just never going to play. So you don't have to have perfect stocks, but you definitely want to have some type of selection criteria. You don't want to be playing 2-7 all the time, or 5-9, or king deuce. You can win with those, just like you can make money in some stocks that are lower par, subpar selections, probability wise, right? You want to deal with probabilities. You want to have very good stock selection. So industry group strength, relative strength, earnings and sales, ROE, IBD proprietary ratings like EPS, group strength, composite. These are things that I use to improve my stock selection. And then last but not least, definitely not least, in fact, way up the food chain for me is sponsorship. I want to see, does Fidelity Contra have a position? Does Lord Abbett? Does T. Rowe Price New Horizons? Some of these really good funds, do they have a position in the stock so that I know that the company has been vetted? 3, very, very important. I want to push the good hands with big bets. And that would be in the stock market, concentration. So if I have a really good stock, I don't want to have a 1% position. If I have 1% of my money in Facebook and it goes up 400%, it tells a great story at a cocktail party. I can tell everybody I'm up 400% in Facebook, but it didn't move the needle. Barring all other trades, the whole portfolio moved 4%, right? So I want to have something that's going to move the needle when I'm right. When you get pocket aces and you want action, you want to build a big pot if you can, if the hand is good. So when I get a good setup, when the market's behind my back, as far as the tailwind, and the earnings and sales and the company, like it's a product maybe that I use, I want to concentrate. I want to have a big position, 10, 15, 20%, at least, sometimes more. I've gone way more before. It's not common, but I will do that. Now you can only do that if you have a loss cutting strategy or a sell strategy, if you start to get ahead. So that's why we have sell strategies for the stocks we're in. That's why we stop ourselves out, because we're usually using a larger amount of our capital versus just sprinkling about a bunch of 1% bets and leaving them and seeing which ones will work. So market direction, stock selection, concentration, 3 very important things to doing well in the market. All right, here's the contact information. Reach us at marcussmith.com, 800-831-2525. The Twitter handles. Sometimes I'll get messages on Twitter. I apologize. I don't usually respond to them. I do read them. I do get feedback on these videos that I'm doing. And it's not all positive. So that's fine. One guy said I was too downtrodden. He felt like, I know the market's bad, Scott, but you seem so depressed. I found that strange, but it is what it is. I don't feel depressed about the market. I guess I don't want to sound, exuberant about it, because I do know that some people out there are getting hurt. And I don't want to run around and beat my chest because I'm not getting hurt, because I have rules. So maybe that was it. But anyways, I do read the feedback, and we do get emails, and I do read it. Is positive or negative? So either way. All right, thank you guys. Have a great weekend, and we will see you next week. I think is the Stay in Step webinar. If that's the case, it'll be on Thursday. And so therefore there will not be a Friday take on the market. Have a good day. Bye-bye, everyone.